We're speaking today with Simon Johnson, who is a professor at MIT and also a former chief economist at the International Monetary Fund, and the author of 13 Bankers, The Wall Street Takeover, and the Next Financial Meltdown. Welcome.
Thanks for having me.
In your book, which was written before the recent financial legislation was passed, you have a sentence in there that's predictive, and it says, "It's likely our government will use this legislative cycle to declare victory over the financial crisis without addressing its most fundamental cause." Is that what's happened in your view?
I'm afraid so, yes. The book was finished in January of this year. The legislation obviously was debated most intensely in the Senate in March and April, and it passed in the summer. There were some steps in the right direction. This is the Dodd-Frank Financial Reform Act, and some steps that I definitely support, but it's not enough. It doesn't really address the fundamental causes. And I think the financial system, if anything, is becoming more dangerous than it was even before 2008.
Could you tell us what were the positive points in the bill, just a brief summary of your views, and what the big gaps were? Well,
the big positive was obviously consumer protection, and the fact that the President has now put Elizabeth Warren in charge of figuring out how to implement and how to build an agency as mandated by the statute. That's terrific. That's exactly what we needed. But in terms of system risk, in terms of making the biggest banks less risky, in terms of reducing the kinds of interconnections that almost brought down the world's financial system at the end of 2008 and early 2009, the legislation makes very little progress, if any, in the right direction there.
Of course, proponents would say that it did make progress and that it has ended the worries about too big to fail. You obviously disagree. Can you tell us specifically why you disagree?
The heart of the argument on behalf of the Dodd-Frank legislation with regard to too big to fail is that there is now a resolution authority and a resolution mechanism so that the FDIC on behalf of the government can take over, shut down, manage the failure of any kind of financial institution. Previously, they could do it for depository institutions, institutions, banks with insured, FDIC-insured deposits. Now, in principle, they can do it for everyone. But they can't, because our largest banks are global banks, and there is no cross-border bank resolution failure mechanism. Nor is the G20 taking up the issue of how to construct one, nor do any of our major trading partners want to have such a mechanism. So if Citigroup, hypothetically, were to fail, Citigroup operates in more than 100 countries, how would you manage that? What would the FDIC do? What's the mechanism for the failure, for losses to be faced by creditors? And the answer is if you take this up directly, face-to-face, off the record with senior administration officials, they'll concede the point. They'll say, well, actually, we would support the institution. We'd have to do a conservatorship. Conservatorship is a bailout. Conservatorship is protecting the creditors. That's not a resolution mechanism. And the creditors know this. So the big banks, the global banks, the ones at the heart of the previous crisis, are invulnerable in the sense that their creditors cannot face losses.
So without a global mechanism, really, the United States, however well-intentioned, would be unable to protect against banks that are too big to fail because they could crash the system, ultimately. And so does that mean that bankers today are back again to being confident that they can take on what I think you call in your book many times, excessive risk, and that the public will take care of any downside and they'll be able to skim off the upside, which is what the perception is that happened last time?
Yes, that's exactly where they are. Of course, there's a cycle. And right after a major financial crisis, you're going to be somewhat careful. That's understandable. And that's why you don't see back-to-back global financial crises, not year in, year out. But over time, as we go through this cycle, we're going to have the same sort of risk-taking. Jamie Dimon says you have financial crises every 3 to 7 years. Hank Paulson says it's 4 to 8 years. Larry Summers says 4 to 9 years. Doesn't matter. These big guys agree, and they're right, that you do it again, because the system of incentives and the structure of these organizations is essentially unchanged.
So then the question starts to be, what else might be done about that? And you quote Alan Greenspan, of all people in your book, saying that if they're too big to fail, then they're too big. And he goes on to say in his prescription, and this was just about a year ago, so not all that long ago, break them up. In 1911, we broke up Standard Oil. So what happened? The individual parts became more valuable than the whole. Maybe that's what we need. And I know that this is what you advocate in your book to some degree. Break them up in the sense of reduce their size. So could you talk about how that would work? I know you talk about size limits, and you have some ideas and mechanisms on what that would look like.
Yeah, absolutely. This is the heart of the matter. And in addition to Alan Greenspan, I'm now citing Gene Farmer, the father of modern finance, the person really behind the idea of efficient markets in finance, who said on CNBC recently, after we'd finished the book, he said, too big to fail is an abomination. It's not a market. It's a government subsidy scheme, and it should be ended. And the best way to end it is to update and apply the Regal-Neal Act of 1994. Regal-Neal sets a size cap on our largest banks as a share of retail deposits. No bank can have more than 10% of total retail deposits. The idea that was proposed as an amendment to Dodd-Frank by Senators Brown, Sherrod Brown, and Senator Ted Kaufman was that there be a hard size cap in terms of the size of bank relative to the U.S. economy. You can put that in
GDP.
Exactly. Relative to GDP, so that no individual bank can become big relative to your economy. Now, we can discuss where that limit should be drawn. I would definitely be in favor of a much lower limit. We can put a dollar number on it, if you like. But that basic idea of a hard size cap beyond which you cannot go, I think, is what you need in the American situation.
And I think in your book, when you were talking about what that level should be, you said something that would be akin to where banks were in size in the mid-90s or so. So we're not talking about draconian reductions.
Absolutely. So Goldman Sachs in the late 1990s was about a $200 billion bank. Let's call it $250 billion in today's money. Before the crisis, in 2008, their balance sheet peaked at $1.1 trillion. Now, what did the U.S. economy as a whole, what did the financial system even gain from that big increase in size of Goldman Sachs? Nothing. No one can point to any economies of scale or scope or other benefits from increasing size above about $50 billion in total assets. So there were lots of benefits for sure, private benefits for Goldman Sachs. The CEO gets more compensation, definitely. The CEO, by the way, in this period of rapid growth was Hank Paulson, who later became Secretary of the Treasury. But if you go back, if you ask or force Goldman Sachs and banks like that to go back down to the days where there are 200 billion, or maybe we even end up with 100 billion as the hard cap, what's the damage? What do you lose from that in terms of either the functioning of the American economy or the functioning of the global financial system? And the answer from all the experts I've talked to, both academic and practical, people really in the business, the answer is you wouldn't lose anything. You don't remove system risk completely, of course. There is no magic bullet. These measures we're proposing are surely not sufficient to reduce financial system risk. We're just arguing that they're necessary and also that they haven't been taken.
The other interesting stat in the book, I think I've seen this elsewhere also, was I think it's the percentage of corporate profits that the financial industry represents. And I might have this a little off, but I think this is roughly right, that up through maybe the beginning or middle of the 80s or maybe even a little bit later, the most the financial system ever took up in total corporate profits in the U.S. was about 15% or so. By just prior to the crash, it was up to 41%. In other words, the financial services industry was earning 41% of all profits in the U.S. That's something that we never even got close to in the past. It suggests that maybe something was out of whack. Why didn't anybody see that? Oh, I know some people did, but where are we now, and how long do you think it might take before we get back up to that, according to your view, what's likely to happen?
Well, we're heading back into similar territory. The financial sector profits are strong, and I think they're going to really do well, partly because there's fewer of them. There's less competition. There's more market power in this area. But you're absolutely right. It's a wake-up call, because those are not real profits. Those are not risk-adjusted profits. Those are not profits if you go back and state them against the losses that were incurred, because a lot of those losses were transferred to the taxpayer. Larry Summers says that 40%, financial sector profits at 40% of total corporate profits is a warning sign, and we should have taken it as such. And he's absolutely right. When you show those numbers to the CEOs of non-financial companies, they're staggered, actually, and quite shocked. And so they should be. But they won't do anything about it. They won't even participate in criticism of the financial sector. They've actually closed ranks, protecting the biggest banks. And that's very dangerous for them individually, for their companies, and for all the people who work for them, because this is the big risk facing the United States going forward.
The other thing that's interesting, and you talk about a number of different problems with too big to fail, such as taxpayers end up on the hook for all the money, but also this idea that because the backup, the backstop, the implicit guarantee, the moral hazard is basically there, but only for the very largest banks, that the next tier down, say large regionals and so forth, they're actually put at an unfair disadvantage competitively because they don't have that subsidy, and therefore they can't operate in the same way, and it's not a level playing field. And yet we don't see too much opposition from them either. You just talked about the corporate sector in general. What's going on here?
That's a very interesting question, and you should pose it to the bankers themselves. I don't think I can speak on their behalf, but I think I would certainly agree and underline there is a big divergence in interest between the mega banks, the mega global banks that have this implicit government guarantee now, and therefore a lower cost of funding, and the banks they compete against in many markets, including the mid-sized banks and the community banks. It's not fair. It's a government subsidy scheme that's not fair, not transparent, and very dangerous. But the U.S. corporate leadership, unfortunately, feels they should stick together in situations like this. The Chamber of Commerce has certainly spoken out consistently on behalf of the big banks, and claiming to speak on behalf of small business. It has opposed almost all of the sensible provisions of the Dodd-Frank Financial Reform Act. I find this extraordinary and disconcerting. And I spend a lot of time, I'm a professor of entrepreneurship at MIT, among other things. I talk to a lot of business people. I work with entrepreneurs in the US and around the world. And I spend a lot of time with them on these issues. And I think over time their view will change. But it is unfortunate, and it definitely affected the political process in this go-around, that the business sector, the non-financial business sector, didn't get it. They don't understand how much they and their families and their people have been damaged by the irresponsible, reckless, unnecessary behavior of the big banks.
Given that that you don't think that the latest round of financial reform has done the trick, let me just turn to something else that you say in your book. We face the prospect of a 1920s-style roller coaster, meaning the economic cycle will be more volatile, I believe. And then you say, this is a recipe not for stagnation, but for a meta boom in which we will receive warnings, including painful recessions, but consistently ignore them. And one last thing, the 1920s opened with an 18-month recession, an eerie parallel to the 2007-2009 experience. It ended with the great crash of 1929. So, not that we want to be talking about depression necessarily, but I think you want to talk about volatility and certainly recession such as we have now. Or maybe you do want to talk about that.
Well, I want to emphasize that too big to fail is not the worst of our problems. I actually had this conversation with a leading banker, a gentleman with a great deal of international experience recently. And he said, well, look, too big to fail is part of the scenery now. You just got to deal with it. Now, I agree on a tactical level that is actually correct. I don't think that there is anything on the table or waiting in the wings that will make any difference to the rising power and the dangers posed by these big banks. But too big to fail is not the worst of our potential problems. It would be too big to save. Think about Ireland.
Too big to bail.
Absolutely. Ireland allowed its three largest banks to build up total assets 2 times the size of the Irish economy, and then they failed. The Irish government issued a guarantee that, at least as we speak today, covers all the liabilities of those banks. They turned a financial banking sector problem into a fiscal issue, and in my view, and this is something we write about on our website and we go through the analysis, in my view, and I certainly disagree quite strongly with the views coming out of the official sector, but I would point out the market is moving in my direction on this issue. My point is that Ireland can't afford the bailouts they've taken on. It's not fiscally sustainable. So
it's kicking the can down the road.
Well, it's trying to kick the can down the road, but it's not moving. The can's too big, right? You're going to break your foot. You're looking at a fiscal disaster. You're looking at a sovereign debt issue. And I think we must take this seriously for the United States.
When will that actually hit the wall, though? Because I say kick the can down the road in the sense that there's no panic, there's no strong reaction. There was a strong reaction, and then certain steps were taken. And maybe we can talk about that, because I know also in that blog piece you talked about perhaps one way out for Europe is to issue some form of Brady bonds, which were used to help bail out Latin America which I think essentially just spread the debt out over a long period. Is that right? Was that the main mechanism that allowed them to work? And you're recommending those to be used in Europe as well?
Well, what helped Latin America at the end of the very difficult and essentially lost decade of the 1980s, was that they restructured their debt. They were allowed to extend their payments, reducing the debt burden, reducing the cash, and there was a, let's say, regulatory compromise reached, including the Brady bonds, that allowed the banks not to mark down their debt so much. So this is how they squared the circle of not wanting to recognize the losses among the lenders and letting the borrowers get somewhat off the hook.
So it's a forgiveness of debt a little bit without it being recognized, so it's sort of accounting.
It's how you forgive the debt in a situation where you don't want to look like you're forgiving the debt. So something like that for Ireland and maybe for other Eurozone countries, I think should definitely be considered seriously. It is unfortunate that the official sector never wants to consider such options until it's too late, until they have to scramble, until they have to do things in a manic rush over a weekend. I think now is the time to prepare for that kind of sovereign debt restructuring. And as we look forward, I would emphasize that while the moral hazard in and around the big banks is absolutely huge and will be a major problem that we face, resolving that, looking at the implications. Moral hazard around lending to governments that are regarded as safe, will also be an issue.
Can we just define moral hazard for folks that are watching so they can be clear about what it is?
Oh, moral hazard is very simply that when I give you insurance, you're going to be a little bit less careful. And if you go back to it's interesting, you go back to the foundation of the Federal Reserve, 1913, quite late for the formation of a modern central bank compared to other countries comparable to the United States, there was a big debate about this issue because the bankers said, we want protection. The financial markets have gone too big, too complex. We can't support ourselves. This is what they learned in the crisis of 1907. We need the government to be involved. In fact, the government had put in a big amount of cash in 1907 to save some of the private banks. And the debate was, okay, you, the bankers, want support. That's fine. Nobody wants a global or even national financial collapse. But there has to be a quid pro quo. We need some oversight. We need some regulation, or what we now call regulation supervision. So that's the essence of the moral hazard problem. But unfortunately, it hasn't worked. It didn't work, by the way, in the 1920s either. That's why you got a runaway boom. That's, the banks went crazy in terms of taking risk and keeping risk on their own balance sheet. But that's why we got the reforms of the 1930s. And those worked for about 50 years. And then they were systematically, carefully, with a great deal of forethought, dismantled. Well, that's why we got the crisis of 2008. We did not, though, go out and rebuild the modern equivalent of those constraints that were put up in the 1930s. The Dodd-Frank bill doesn't do that, and therefore we still have the same problem that we had prior to 2008 and in the 1920s.
So that's the meta boom cycle that you're talking about?
Yes, that's
as a parallel.
And that's my baseline scenario. We call our website baseline scenario, meaning we have a baseline view. We move it from time to time, but as we speak today, that is my baseline view.
And since we touched on Europe, could you give your view of the Basel III Accords, which is the latest European financial legislation or reforms, and maybe draw some parallels between that and what was done in the U.S.?
Well, the Basel III is a global agreement. There's 27 countries on the Basel Committee, and they agree on a lot of things around bank regulation, with first and foremost issue being bank capital. And the problem at Basel III is that while the US does want somewhat higher required capital in banks, the Europeans don't, and actually the Japanese don't. And as a result, we end up with a compromise, which is what people often call least common denominator, and which in common English you could say not enough. So the capital required at the end of the day, when you make all the adjustments by Basel III, will be about 10% Tier 1 capital. That's roughly what the US banks have had for the past 2 decades. So there's no change in required capital relative to what US banking practice has been.
But it will help Europe in some way, presumably.
If they follow the rules. Unfortunately, they have a track record of providing many exemptions and exceptions to their most privileged banks.